Good morning. Here is the one thing worth carrying into today. Last night, Nvidia reported the largest quarter in its history and then did something it has never done in 33 years of existence. It guided a full year ahead. 70% revenue growth for fiscal 2028 against a Wall Street modeling 44. The stock rose 7% and the argument about an artificial intelligence bubble was declared settled again. But turn 2 pages further into the same filing. Net income for the quarter, $59.7 billion. Free cash flow for the same quarter, $21.3 billion. The quarter before, free cash flow was $48.6 billion. Revenue rose 18% from one quarter to the next, and the cash the business actually generated fell by more than half. That gap has a name. It is sitting on the balance sheet, and nobody put it on a thumbnail. Here is the board. The S&P 500 closed yesterday at 7,677, up 0.3%, and is up another 0.4 this morning. The Nasdaq closed at 26,151, up 0.7, and is up about 1% today on chips. The Dow closed at 53,577, its third straight gain, and is roughly flat this morning. The 10-year Treasury yield sits near 4.65%, off a 20-month high of 4.75 set on the 21st. Gold is $4,585 an ounce as of 9 this morning Eastern, down from $4,614 yesterday, on the inflation print and positioning ahead of tomorrow's central bank speech. Bitcoin is around 79,300, having tagged 81,235 on the 25th and been rejected. Brent crude is $86.93, West Texas 81.36, both down about 1%. The dollar index is near 99.2. One note on index concentration. The top 10 names carry an outsized share of the S&P, near record levels, but published estimates of that share disagree enough that we are not going to put a decimal on it. The direction is not in dispute. First contrarian read. Everyone is treating a $2 trillion backlog and a first-ever year-ahead guide as proof that demand is settled, and the demand is real. Here is the tell. Accounts receivable. At the end of the last fiscal year in January, Nvidia was owed $38.5 billion by its customers. 6 months later, on the 26th of July, it was owed $63.1 billion. And $22.3 billion of that build happened in this single quarter. That is not our arithmetic. It is a line in the company's own cash flow statement, sitting there as a reason cash generation fell. On a quarter that did $96 billion of revenue, that is roughly 60 days of sales recognized but not received. Inventories climbed from $21.4 billion to $31.6 over the same 6 months. And a business generating $59.7 billion of quarterly net income at a 75% gross margin borrowed $24.9 billion in the quarter, taking long-term debt from $7.5 billion to $32.4 billion. High conviction on the mechanics, because every figure there is straight from the filing. Medium conviction on when it starts to matter. Second read, the 70% growth guide is being read as a forecast of what customers will buy. Listen to how management actually framed it. The chief executive said the company has supply for 70% growth, and that demand is much greater than 70%. The chief financial officer called the figure supply constrained. Read that literally, and the number is not a demand curve at all. It is a disclosure of what the manufacturing chain can physically produce. Those two statements fail in completely different ways. A demand forecast fails when buyers change their minds. A production schedule fails when buyers cannot fund the invoice, and there is a margin tell inside it. This quarter's gross margin was 75.0%. Next quarter is guided to 74.0%, a full point lower by the company itself. The reason is memory cost. The single largest input in the product is also the scarcest component on Earth right now. So the business with the most pricing power in technology just told you its margin goes the wrong way. High conviction. Third read, and a different sector. Salesforce jumped 11.2% yesterday, and the reading everywhere was that the fear of artificial intelligence eating enterprise software has been overdone. Look at the composition. Revenue grew 10.8% to $11.3 billion. That is perfectly ordinary. Adjusted earnings per share came in at $5.90, and net income rose 73% year-over-year. The full-year revenue guide moved to $46.25 billion at the midpoint, from $46.05. That is a rounding error. The earnings guide moved a great deal more, so this was not a growth re-rating. It was a company converting a fixed cost base into profit, while the top line did what it was already doing. The mechanism worth carrying is that the market has changed what it will pay software companies for. 2 years ago, it paid for seats. Today, it pays for operating leverage, because a margin story is the only proof available that does not require answering the question of whether headcount-priced revenue survives at all. Medium to high conviction. CrowdStrike, up 9%, tells a similar story. Now follow the money. July's personal consumption expenditures price index landed yesterday. Headline 3.7% year-over-year, a tenth above consensus and unchanged from June. Core 3.3%, exactly in line and also unchanged. Both rose 0.2% on the month. The honest summary is that inflation has stopped improving without having obviously gotten worse, which is the most awkward possible outcome for a central bank being asked to justify a direction, and the direction has quietly inverted. Markets are now pricing roughly 1 in 3 odds of a rate hike in September, with futures showing about a 45% chance of a hike by December. Read that twice. The debate at the start of this year was how many cuts. The debate now is whether the next move is up. Gold pulled back from $4,614 to $4,585 on that print and on positioning ahead of tomorrow. The dollar sits just under 100 on the index. 2 central bank stories today, and only one of them is priced. The first is tomorrow. Kevin Warsh delivers his first keynote as chair at approximately 10 in the morning Eastern. The symposium's theme is financial innovation and payments, which puts stablecoin and digital currency language live in a way it would not normally be. Under this chair, the institution has stopped telegraphing intentions between meetings, so the speech carries unusual information value. Our read is that this is a framework event, not a rate event. A first keynote is where a chair tells you how he thinks. The tail risk is a surprise reaction function, not a surprise number. The second story got a shrug. The Justice Department says a China-linked contractor ran an intrusion campaign against the Justice Department, NASA, the Federal Reserve, and the United States Senate, going back to at least 2018. 8 years of dwell time. Delivered through thousands of conscripted consumer devices, ordinary routers and cameras, so the traffic would not appear to originate in China. Hold those two together. The institution being asked to design the future of American payments infrastructure has just disclosed a confirmed multi-year intrusion. And there is a third thread running underneath both. On the 19th of August, the Treasury said it would at least double its buyback operations, from $2 billion to $4 billion apiece, starting the 9th of September. Stanley Druckenmiller, the Secretary's own former mentor, published a Wall Street Journal opinion piece called "Let the Bond Market Speak," arguing there was no dysfunction to justify it. His words: "This was not liquidity management, it was price management. And if the 30-year has to trade at 5.5% to clear, that is not a crisis, it is an invoice." The sentiment beat. Across market and social sentiment monitoring today, the commentary clustered almost entirely on one figure, the $108 billion guide, and on the biggest security headline of the week. What is striking is what did not get discussed. The single most consequential argument in markets right now, whether the fiscal authority is setting the price of its own debt, was drowned out by a chip earnings report. That is a positioning tell in itself. When attention concentrates this hard on one number, the mispricing tends to sit in whatever got crowded out. One correction worth making out loud, because it's circulated widely today. A claim that a major artificial intelligence lab has announced it will reach general intelligence by the end of this year is misleading. No such company deadline exists. It traces to one executive's personal remark, on his own definition, about an internal system. We are flagging it rather than repeating it. The tell, free cash flow fell from $48.6 billion to $21.3 billion, quarter over quarter, on rising revenue. Operating cash flow fell from $50.3 billion to $24.1. And of the $59.7 billion of reported net income, $7.77 billion came from gains on equity securities, which means roughly 13% of the headline profit came from marking up the value of stakes the company holds in the ecosystem that buys its chips, not from selling chips. None of that means the demand is fake. It means the shape of the business is changing underneath the headline. A company that sells for cash reports revenue and collects. A company that finances its customers reports revenue and waits. On the supply side, there are now roughly $279 billion of supply commitments. On the customer side, a newly announced arrangement with Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, and KKR, in the filing's own words, mobilize over $500 billion of third-party capital, subject to definitive agreements, to deliver $700 billion of revenue in fiscal 2028. Somebody has to fund $700 billion of purchases. Crypto and to dates the market appears to be misreading. Bitcoin tagged $81,235 on the 25th, its first print above 80,000 in 3 months, and was rejected. It sits near 79,300. The stated drivers were Treasury's long bond buying and legislative momentum, which brings us to date 1, the 15th of September. Circulating widely as a catalyst for crypto market structure legislation is a cloture vote. That is a procedural step to end debate. It is not passage. Positioning for a binary outcome on a procedural date is positioning for the wrong event. Date 2. A consortium including Bank of America, Wells Fargo, and Santander is moving on a bank-issued stablecoin, and this is being read as banks capitulating to crypto. The commercial platform is anticipated in the first half of 2027, not now, and it is closer to a walled competitor to the existing stablecoin issuers than to adoption, which is precisely why Circle and Coinbase equities sold off on the news rather than rallying. That reaction is the tell. Sectors in play. Semiconductors first. $96 billion at 106% growth with a 75% gross margin is the best large capitalization income statement in the world, and the next generation platform is in full production. Against that, the margin guide goes down. Receivables and inventory are building faster than revenue, and a new round of semiconductor tariffs is reportedly under consideration in Washington, which is a direct threat to the guide's assumptions. Own the mechanism, watch the cash conversion. Memory second, and this is the sector actually capturing the margin that just got guided away. The 3 manufacturers who make essentially all of the world's memory have shifted capacity toward the high bandwidth type that accelerators require because it earns far more per wafer, and analysts expect tightness to persist into 2027. One honesty note. Reported price increases over the past year range from roughly double to figures we consider unverifiable, so we will describe the tightness and decline to quote a percentage. Enterprise software third. Salesforce up 11.2, CrowdStrike up 9. The disruption discount is compressing, but it compressed on earnings quality rather than demand. A re-rating on margin is a real re-rating. It is a gear, not an engine. On the radar, tomorrow at approximately 10 in the morning Eastern, the first Jackson Hole keynote of this chairmanship. Framework risk, not rate risk, and the payments theme makes digital currency language live. The 9th of September, the expanded Treasury buyback ceiling takes effect, and the argument about whether the fiscal authority is managing the price of its own debt gets tested in real time. The September policy meeting, with roughly 1 in 3 priced for a hike rather than a cut. The 15th of September, the cloture vote, procedural rather than decisive. Late November, Nvidia's October quarter, where the line to open first is receivables, not revenue, and running underneath all of it, the semiconductor tariff decision, which is the cleanest single threat to every artificial intelligence capital expenditure forecast currently in circulation. The scorecard, 3 new calls, all dated today and all falsifiable. Call 84-1. By Nvidia's October quarter report, expected in late November, free cash flow will again come in below half of reported net income, and accounts receivable will exceed $70 billion. Falsified if free cash flow reaches half of net income or receivables come in at or below $70 billion. Medium to high conviction. Call 84-2. The 15th of September will not be a passage event. No enacted crypto market structure law by the 30th of September. High conviction. Call 84-3. Tomorrow's keynote will change the framework language rather than the September call. Within 1 week of the speech, Market implied September odds move by less than 20 percentage points in either direction, medium conviction, and one standing position. The case for hard assets as an expression of a fiscal credibility view rather than momentum remains the spine, and it is currently supported by the Treasury intervention argument. $81,235 in Bitcoin is the near-term referee. A reclaim confirms it. A failure to reclaim by mid-September puts the tactical case on the defensive without touching the structural one. The market spent last night arguing about whether $108 billion was enough. It never asked the more interesting question, which is who writes the check. When the most profitable company on earth begins extending credit, pre-buying supply, taking equity in its own customers, and helping assemble $500 billion of outside capital to fund their purchases, is that a business with unlimited demand or a business that has decided demand needs help? Those may not be opposites. They may be the same fact seen from two ends of the balance sheet, and the answer shows up in the receivable line long before it shows up in revenue. Watch tomorrow. Watch the 9th of September. And in November, skip the headline and open the cash flow statement first. Research and education only, never personalized advice, and every number in this brief is sourced in today's written issue. There is also a focus episode today going deep on exactly this. I'm Earl, the asymmetric signal, one contrarian read a day. Subscribe.